Global bond markets hit a value of $123.5 trillion in 2020. In this video, we're going to talk about what a bond is and why you may want to consider bonds as part of your overall investing portfolio. When you buy a bond, you're lending money to the issuer of the bond. Well, typically bonds are used by companies or governments to raise capital. There are various types of bonds, and we're not going to attempt to cover them all in this video, but they all have the same key components: an end date known as maturity, terms for when payments are made, and an agreed upon compensation rate for the bondholder known as the coupon. Well, typically, a bond is issued with what's called a par value. Normally, par values are either $100 or $1,000. The par value is the amount of money that the bond issuer is borrowing. If an investor purchases a bond at a par value of $1,000, the investor is lending $1,000 to the bond issuer. The bond issuer will pay the interest at the coupon rate to the annual investor, typically on an annual basis, until the bond reaches maturity, at which point the bond issuer will repay the par value of the bond. Once a bond has been issued, it can trade on public exchanges. The price for the bond on the public exchange is the market value. Market value can vary greatly from par value as conditions change. Supply and demand and fluctuating interest rates, for example, could both change the value of a bond. Well, let's look at a simplified example. A company issues a 20-year bond with a par value of $1,000 and a coupon of 5%. Well, that means the company will pay $50 in interest per year for every $1,000 that it borrowed. Well, 6 months later, similarly rated bonds are being issued with a coupon of 6%. Well, since the new bonds have the same risk profile the old bonds did, it makes sense that investors will want to sell their existing bonds in order to invest in the new bonds at a higher yield. The problem is that no new investors will want to purchase the old bonds at par value because they know the new bonds have a better risk-adjusted return. What this means is that the market value of the first bonds will adjust to match the yield of the new bonds. In this case, the old bonds would trade at a market value of approximately $833. That way, the yield on both will be the same. Generally, you can say that as bond prices go up, bond yields go down. As bond prices go down, bond yields go up. There are several advantages and disadvantages that bonds have when compared to stocks. The biggest advantages include security and stability. Bonds are considered to be very safe investments, but not all bonds are created equally. For example, United States Treasury bonds are considered to be the safest investment vehicle in the world, but a bond issued by a company with a weak balance sheet is not as secure and might be considered more speculative. More speculative bonds pay a higher coupon, but they're also considered riskier. The two biggest bond rating agencies are Moody's and Standard & Poor's. The rating system they use looks like this. Another benefit that bondholders have is they're the first to be paid out in case of an event such as a company bankruptcy. Stock shareholders are the last to be compensated. Bonds are also considered to be very stable investments as they make regular coupon payments. Well, certain types of bonds, including some government bonds and municipal bonds, are not taxable, and that could provide some advantage to investors as well. Well, there are drawbacks to bond investing that you should probably be aware of. Some bonds are considered safer than stocks, and because of this, they generally don't offer as large a potential return. Other risks include fluctuating interest rates, default risk, and prepayment risk. Bonds can be a useful instrument, but as with all investments, make sure you do your homework before actually investing.